folks. Yes, happy Mother's Day weekend for sure. Obviously, by now, everybody knows the story. The Federal Reserve came out and said that they were going to raise rates by 50 basis points and follow that up with two more rate raises of 50 basis points. And the market initially liked it on Wednesday, rallied 1,000 points to the up. Thursday gave it all back, and then on Friday down as much as 550 points during the day, but then rallied into the close and down only 100. So, Derek, the market is acting like it's trying to find a bottom here, but there's a lot of factors that are going into this.
Oh, absolutely. I mean, so many different factors that are influencing the markets, whether it's Russia, Ukraine, the price of oil, inflation, the Fed, and whether or not they've lost their credibility and so on. But generally speaking, the market, I think, initially reacted positively because Powell essentially took a 75 basis point rate hike off the table, which he really didn't need to do. And I think that's part of the reason that the market sold off on Thursday. It's sort of like, do we really believe in the Fed? Do they have credibility? After all, they were still easing the real estate market until March, when the real estate market was very strong and the labor market was tight.
Yeah, that's right. So what Derek is talking about is all of this liquidity they continued to pump into the economy, despite the fact that the evidence was overwhelming that we had an inflation issue. So that was, of course, like the firefighter who actually started the fire and then came to put it out. So this is the problem that we're having right now. The Fed is obviously at the front, but it's not the only problem. Of course, as Derek illuminated, all of these other reasons that are out there, and of course, lots of tough talk by Russia as well, is certainly making the market unnerved. But this is the way we're looking at it, folks. We go, there is a lot of opportunity in front of us, and you have to know what you own. And you hear me say that all of the time, but there are certain sectors that are doing just fine because of this inflationary environment.
Right. I mean, small cap value stocks have held up very well. And we know the energy sector has been very strong. I mean, many of these energy companies, even at a price on oil of about $70 a barrel, would be making a fair amount of money, with it currently trading at 110. So the energy sector has certainly benefited from the uncertainty. Also, selected healthcare areas have done pretty well. Technology companies that actually make money and are not trading at absurd multiples of sales have held up well. But essentially, this is a point-to-point thing. We ended last year on a very strong note. We started the year on a strong note. And I think what's particularly painful to people is not only are their equity holdings going down in value, broadly speaking, so too is much of their fixed income exposure as well.
Yeah, so let's really unwrap that, because that is a major point. The S&P 500 hit its high on January 3rd to begin the year at 47.96, and we closed on Friday at about 41.24. So, if you look at your statements from the high point, which a lot of people do, from the high water mark to where we are, it shows a down market. That is obvious. The second part, as Derek illuminated, this is the worst bond market that we have seen in our careers.
No, that's absolutely true. The 30-year Treasury bond is down 20% from its highs. Even intermediate-term bonds are down double digits. And so, many portfolio managers hold those types of securities in a portfolio to basically offset the volatility of their equity holdings. And right now, as we said any number of times, when interest rates were as low as they were, you really weren't getting a whole lot of defense from there. And in fact, there was probably more risk in that aspect of that asset class than there was in many others.
And I just wanted to go through a couple of points before we head to break. We, as an investment committee, Derek, we certainly made changes to, but not only the fixed income holdings, but the equity holdings as well. And if you're not getting that kind of care, this forethought, you should think about having a second set of eyes look at your portfolio, because there are things that you could have done, and more importantly, there's things that you can do going forward.